Welcome to Remarkable Retail Podcast, our final episode of Season 6, presented by Market Dial. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this episode, we take the opportunity to reflect on the season that was, talk about our personal highlights, jump into the news of the week, of course, and then dive into our topic for this episode, the year of living efficiently.
I borrowed from the Zuck, from the title. He talks about Meta's year of efficiency. Mm-hmm. So this is similar. Also, some of the older folk that listen to the podcast may remember the movie The Year of Living Dangerously.
Yeah, fantastic movie.
Yes, Sigourney Weaver, for those of you keeping score at home. So, I think it's a great chance to look back a little bit on what we've learned so far, but also look ahead in terms of what we might expect for the balance of the year, and more importantly, what to actually do about it, and maybe some things some traps not to fall into.
Yeah. Well, let's start with the highlights. I mean, for me, the three great retail events we went to, NRF, Shop Talk, and the World Retail Congress, were real highlights. And one of the reasons, in my mind, they were highlights, we interviewed some amazing people, but you and I got to interview in person, which has just a different dynamic. I mean, it's just more fun. We play off each other. We have the three of us typically, and I think it's super fun. And thank God for the magic of the internet, because we can do so many interviews with people.
This internet thing's going to be big. I'm telling you.
I tell you, it could change everything. Like we're talking to Vim out in Amsterdam, and but there's something special about being in person. So those interviews, Carrie Baker from Canada Goose, and of course Judith McKenna from Walmart, and I'm afraid to start singling out any interview. They were all so amazing, so I didn't want to hang on any one specific. But I really enjoyed that experience with you, and you and I being together. So that added a real top spin for me for this season.
It is really a different dynamic. I think we've learned, certainly over the however many episodes it is now, 150 episodes, how to do this thing remotely. But at the same time, it is a different dynamic between us and the guests. Plus, we get to go to some cool places sometimes. Yeah. It's nice hanging out in Barcelona.
Yeah, Barcelona is fantastic. Just to hang out and be part of the mix. And then in Vegas, not so fantastic, but we get to have Jello shots before we do the interviews. So there you go.
Well, maybe you did, but I think my highlights, I mean, that's definitely one. What I would add is we got some feedback, I guess last fall, that that some of our audience wanted us to be a bit more global in perspective. We obviously take more of a North American slant, but we do have a big international audience. So we were pretty successful in getting some more international brands. We had Ryan from the Chalhoub Group, biggest retailer in the Middle East. You mentioned Vim from IKEA, Martin from Lego.
Great interview.
Sally Elliott from who runs global practice for Spencer Stewart, et cetera. So that was great. Well, I think in general, we also really elevated the number of C-suite executives that were on the podcast. We've been doing pretty well with that, but I think we took it to a whole new level this season, which is fantastic. You mentioned some of the folks that we've had on. The other thing is, and we worked hard at this, though it's a continuing challenge, and I feel like we need to do better, it's just more diversity. About half of our guests are either women or people of color. So in particular, we had this 1 month where we had all female C-suite leaders. So Judith from Walmart, Carrie from Canada Goose, Anu from Anthropologie, and Tracy from Walgreens. So that was a great thing to highlight. We also did our first really DE&I focused episode with Jarvis Sam, who used to run diversity, equity, inclusion at Nike. So again, more we can do, but we're very committed to representing more diverse voices on the podcast.
Yeah, listen, it was a great season. Of course, we've been renewed for season 7. We're back July 27th. Our first episode is going to be live from the stage of the Lead Innovation Summit with our good friend of the pod, Simeon Siegel. So the three of us on the stage in New York. So really looking forward to that. In between then, we're going to have a few encore episodes. They're very popular. We pull from the back catalog. We got back catalog now. It's fun to say. We pull from the archives. Deep from the archives. We pull out some of our favorite, or maybe sometimes the interviews that we think could have a second listen. And then we roll into a full season 7. So we already got guests lined up. So that's going to be super exciting. And our season 7 will wrap at the end of NRF this year. So we're changing the sequence a little bit for, again, more inside baseball than anything, but it'll wrap at the end of the NRF show this year. And, while you're listening to this, hope you're enjoying it. Certainly our numbers would kind of look like a lot more people are enjoying it, but, if you can, give us a 5-star review. That helps our rankings and maybe gets a little bit more exposure to even more people. So, all right. Enough of our admin stuff. Let's talk about news of the week. So, supply chain challenges seem to be behind retailers post-COVID. They were certainly front of mind during COVID, but we see a couple of things happening. One is some talk of strikes on the West Coast ports, but now we're hearing some pretty big rumblings about a UPS strike happening in August. Talk about that. What your impressions are about how that's going to impact retail.
Yeah, I don't think we talked about the West Coast thing on the podcast. That looks like it's resolved, I believe, but I guess, there's always challenges there. But yes, there is the potential for a UPS strike in August, and that would be highly disruptive. Obviously, if it ends up happening, UPS has got a very significant percentage of the e-commerce orders. So going, if that happens, we're be in the heart of the back to school season. Clearly, if it were to persist, it could really affect the holiday season. So I'm not smart enough to be able to handicap the likelihood of that, but that's definitely on the horizon. And if that does not get resolved, I think it could really add to some of the things we'll talk about later, just in terms of the challenges towards the back end of the year.
Let's talk about Bed Bath & Beyond. So last episode, we were talking about this intellectual property stalking horse stuff. And sure enough, it looks like it's happened. So talk about that.
Yeah, last week we talked about Overstock made a bid. I think it was about $21.5 million for the intellectual property assets of Bed Bath & Beyond, and they won. That bid was accepted. It's not clear whether there were any other bids that really were competitive. So I think it's quite a bargain for Overstock. Wall Street seemed to agree. The Overstock stock, that's hard to say, Overstock stock was up on the news. And now really the attention is being turned to Buy Buy Baby, which is a division.
Buy Buy Baby?
Bed Bath & Beyond. So there is a separate auction process that has been initiated, and June 28th, so just after this episode comes out, we'll know what happens there. And I think with the intellectual property sale to Overstock, I think we can assume that Bed Bath & Beyond stores are not staying open and not likely to come back, but who knows long term. But in the case of Buy Buy Baby, I think there's a better chance that many, if not all of those stores may stay open. And then just quickly in a related story, in some respects, the Container Store, and we had the Container Store CEO on just about 6 months ago, I guess, at this point, and Dormify, which is a direct-to-consumer brand that focuses on back to college, in essence, are teaming up. And I think this will be part of a number of things. We'll see people going after that the jump ball, so to speak, of volume from Bed Bath & Beyond going out. And they're teaming up for some shops within a shop and carrying Dormify products in, I think it's 35 or 40 of the Container Store locations. So that's not huge in terms of a national scope. It's not even all the Container Store locations. But I think that's an interesting move. And like I said, I think we'll see more announcements about people that are going to really go after that business that's up for grabs.
So off mic, before we started recording, we were talking about the temperatures in Dallas and how hot it was in Dallas. It seems like the heat is on for Neiman Marcus.
Yes.
Like that segue there.
Oh, wow. That's impressive.
So either Neiman's or Bergdorf Goodman up for sale. You have a unique perspective on this, having been a senior executive at Neiman Marcus. And what do you think about all this? What do you think about this potential and this severing of the two brands? It's fascinating stuff, but where does it leave us?
Yeah, so the New York Post broke a story about a rumored possible sale of Bergdorf Goodman. So the Neiman Marcus Group, which runs Neiman Marcus stores and NeimanMarcus.com and a few other things, also owns Bergdorf Goodman, the legendary retailer in Manhattan. And this rumor's can be kind of bumping around for a while, but seems to be picking up steam. And so the story, which I can't independently confirm, but the story was that Neiman Marcus Group and their private equity firms are meeting with potential bidders for the Bergdorf Goodman store to spin it out, given some of the challenges that Neiman Marcus is having overall. So we touched on this last week or the week before, that they reported a pretty difficult quarter, and certainly the immediate term outlook doesn't look fantastic. I guess a couple of things. One is that, Neiman Marcus Group has had kind of a checkered history, I guess, over the last 15 years. When I was there, so I joined in 2004. In 2005, we got bought out by a private equity group. That deal was performing pretty well until the financial crisis hit, the global financial crisis. I was actually gone from Neiman Marcus just shortly before that, in what was probably the luckiest timing thing in my life. But that caused Neiman Marcus to really be back on its heels, and they really pulled back on investment until things kind of improved. Then they got sold to a different private equity group, I guess about 10 years ago now, at a really stupid price, with a really ridiculous amount of debt. That led to them filing for bankruptcy during the depths of COVID. A lot of people blame COVID on that. They were going to file for bankruptcy, or they needed to be recapitalized somehow or other, because the deal was just
So that was going to happen one way or the other.
That was going to happen one way or another, in my opinion.
Yeah.
And I'm on the record prior to COVID saying that was going to happen.
And that was in the same time that they opened up their big New York or Manhattan flagship in Hudson Yards, which was probably
there were a lot
early
of
days for Hudson Yards.
Yeah, there are a lot of unfortunate timing issues there. So it's been now Neiman Marcus got bought out of bankruptcy. There are three private equity firms or investment firms that own them. PIMCO is the majority owner, and I think it's Davidson and Sixth Street Capital that are the minority shareholders. But they got rid of a ton of debt, so their balance sheet is in much better position. But the underlying business is not performing incredibly well. And I guess I'd say a couple of things before I get specifically to the idea of the spin out. One is luxury department stores, and by that I mean Neiman Marcus, Saks Fifth Avenue, are really very mature. And this is one of the challenges when I was the head of strategy to try to figure this out. It's a very mature business model, partially because of the reliance on older customers. And neither Saks nor Neiman Marcus has done a particularly good job of attracting younger customers, which is probably a whole other episode. But there's also things like lots more competition, not only from the Net-a-Porters and ASOSs and Farfetches of the world, but probably even more so from many of the vendors that sell into Neiman Marcus and Saks.
Point. Yeah.
Back when I was there, we were already starting to get very worried about this, because it was a fairly limited strategy. I mean, almost none of the big luxury brands, vendors, had big e-commerce positions, and we were very strong in e-commerce. But had to assume at some point they were going to figure out that they needed to do that. But probably even more impactful is just the expansion of their own stores. So I don't know what the exact numbers are, but if you compare the number of stores that Gucci, Louis Vuitton, Hermes, kind of go down the list, have opened in the past decade, and it's quite substantial.
Big, impressive, experienced flagship stores. We're not talking shop and shops here. They take serious real estate, right? Fifth Avenue,
exactly.
Yorkdale, wherever. What?
Right, and generally in the same mall or very close to where the Neiman's and Saks stores are.
Yeah.
So, in terms of differentiation, it's harder and harder for the wholesalers of these brands to really differentiate themselves. So there's a lot of underlying issues. I think Neiman's has compounded some of their problems by going back to one of the things that I thought was a real risk of being overly focused on the top 1 or 2% of the customers. For example, the Neiman Marcus store down the street, or not down the street from me, but a mile and a half away from me at North Park, which is probably still one of the top stores in the chain, that store doesn't work. It's a 150,000 square foot store. You can't make that store work just counting on the top 2% of shoppers, even in an incredible fashion market like Dallas and the home of Neiman Marcus. You need to cast a wider net. So if you wanted to be a 20-store chain with your stores being half the size, you could probably have an extremely profitable $2 billion business. unfortunately, Neiman Marcus is scaled as a $4 to $5 billion business. And so the addressable market as a practical matter is just getting way more competitive. Saks and Neiman's probably don't work. There's a lot of overlap in their locations. And so in terms of what could happen, I think out of desperation, they might sell Bergdorf. I think that would be a mistake.
Who would buy them? Like private equity?
I think
like
sovereign.
Sovereign wealth fund?
Yeah, probably a sovereign. I mean, and this is something I'm probably getting too far into details here, but Bergdorf Goodman is a very special brand. So really, particularly since the Hudson Yards store at Neiman Marcus closed, Bergdorf Goodman is really basically the Neiman Marcus store on steroids in the New York City area and for tourists. So spinning it out, I think there's a lot of overlap in vendors. There's a lot of infrastructure to support it. So I think it could happen, but I don't. And the reason I think it's a sovereign wealth fund sort of investment is because they would be willing to throw a lot of money at it, which it would need to really expand. And it's a crown jewel, so to speak. No pun intended there. So we'll see. I mean, I think it's just unfortunate that a brand like Neiman Marcus has gotten to this point. Another thing that could happen, I know there are a bunch of rumors that Neiman Marcus CEO is not loved by a couple of the investors. I don't know that directly. So we might see a management change as a way to kind of appease the parties. So it's something to watch, but I think it does really speak to kind of the fundamental challenges in the luxury department store world. And again, given what we see with the economy, they're not going to have the wind at their back, at least for a little while.
Yeah. And we should probably tie it into one of our predictions as we've been doing, not having a full check-in on the prediction episode, but kind of as we go, the hybridization of retail steals the crown. Look at how many times the crown's coming up from omni retail. Like, when we have this discussion with folks like IKEA, who says, well, there's only so many big blue boxes we can put in. Let's have something different. Ulta and Sephora. The impact of locals. So just connect those dots for us as we kind of wrap up the news.
Well, it's a little bit of this kind of what I think is a real challenge, not for all, but for many brands of really protecting a model, particularly a physical store model, because Neiman Marcus is very strong in e-commerce and has been for a long time. So it's really more about the physical manifestation of this kind of one-size-fits-all strategy. When you have very few stores, you're really counting on a large draw from great distances. That does work pretty well for the top 1 or 2% because they have the money to spend. They love you. They don't have a lot of other options. If you really look at it on a market by market basis, and this is the way to make it less about Neiman Marcus, but I would say, if you really look at a trade area and you think about the powerful categories and you understand why you're not getting your fair share across the geography, in many cases, it has to do with convenience. And I mean convenience both in terms of proximity to where you are, or forcing the customer to travel a great distance, deal with the parking lot, go up the escalators to get similar products. So I think what we see with IKEA, what we see with Dick's, sporting goods experimenting with different formats, Best Buy, et cetera, is more this portfolio approach to formats. So you got kind of this hub store, which is a destination, and then maybe have some sort of satellite kind of stores, which are either focusing on a particular kind of customer or particular product category, but also probably being kind of an omni-channel service center, right? Because, you can take some real advantages, a little bit like what Nordstrom has done with local, though I'm amazed that Nordstrom local hasn't been expanded. I think that's a huge miss on the part of Nordstrom.
All right. Well, before we get to our the rest of our episode, which is the year of living efficiently, let's hear a few words from our presenting sponsor. If you're a retailer hungry for a better way to gain useful insight on the impacts of your store layout, design, and strategic initiatives, you need to know Marketile. Marketile is an easy-to-use testing platform that emboldens great decisions, leading to reliable, scalable results. With Marketile, you can be confident in the outcome of your in-store pilot initiatives before rolling them out across your fleet. Validate your remarkable ideas with Marketile's in-store testing solution. The proof is in the testing. Learn more at marketile.com. That's marketile.com. Let's talk about this this year of living efficiently. So it was really it came out of the Zuckerberg looking at the year, what they were spending, how they were spending money, metaverse kind of stuff. Now, why did you choose this to close out our season? Is it to you a kind of a full circle with the way we started it, which was when the tide goes out, we see who's swimming naked kind of framing? Is that what you were thinking?
That's definitely part of it. We tried, I guess, to warn people that things were getting tougher. And, that may be playing out a little bit more slowly than we originally envisioned, but it's definitely happening. And I think, the general tendency, not just in retail, is when business gets tougher, you get hyper-focused on efficiency, cost reduction, store closing,
right.
Those kinds of things. And I think, there's plenty of reasons to be concerned about the next 6 months, perhaps more. We've got issues on the consumer side where disposable income is not keeping pace with inflation generally, and some other things. A lot of retailers are, we've already seen, if we look at just the most recent set of quarterly earnings, many retailers either with negative sales or even if they eked out a small gain are basically signaling that they expect sales to be flat to down the balance
flat as the new year. Up. Yeah.
And I think if we look at the retail tech environment and service providers, we've seen a lot of layoffs, a lot of pullbacks. Everybody from Shopify to Salesforce, et cetera, et cetera. So there's definitely
long list.
This environment of kind of contraction. And then there's some particular things that may have been good ideas all along, but I think are putting like a hyper focus on this idea of cost reduction efficiencies. More retailers getting serious about returns reduction. This is a problem we've seen coming for years, but now seems to be getting a lot more attention. This whole issue of crime and loss prevention kinds of issues, and trying to strike the balance between what I call loss prevention versus sales prevention as people, start to lock stuff up or have more security. I think a lot of dialing up of interest. This is a longer term trend, but the reality that the war for talent is probably not going to get any better. There's the demographic factors. There's the work from home.
What did I see an executive, and it reminded me what Ira Kalish and we talked about it back in New York, this hoarding of employees. Like at the one hand, you've got big layoffs, but on the other hand, you've got employers who are reluctant to lay people off because they're afraid they won't get them back. So it's a really interesting dynamic.
Yeah. But I think you have to go into this generally, not true for every retailer, but if you assume it's going to be difficult to acquire or retain talent, then, how do you change your processes to deal with that? How do you, do you invest more in automation, robotics, those kinds of things? Then you've got generative AI, which obviously is getting a lot of attention. I think the easiest applications in many cases are labor reduction, cost savings. And then this is driven, probably would happen anyway, but I think particularly given the pressures on margins, the interest in retail media is a way of saying, okay, well, if we can't drive the top line, drive gross margin dollars and products, well, maybe we invest in retail media networks to increase your margin. I think it all at one level makes sense if the tide is going out, if you're very worried about your ability to pay the bills going forward, then having focus on cost efficiency is generally sensible. I think it's really more about being careful in how you approach it, that you need a strategic layer, that you have to be much more surgical because you could actually, risk some things happening that are unintended consequences.
I love that, unintended consequences. Let's talk about the consequences of, in some ways, COVID. I mean, we're in a post-COVID rebalancing. So as we cast our minds forward and think about some of these implications in the contemporary sense, i.e. in 2023, 2024, there's a bunch of things we've been talking about all season, the great pull forward, e-commerce reverting to the mean. Talk about those and how you're looking forward to the rest of the year and into next year, and how we should be thinking strategically about the implications of these things.
Yeah, so I'll touch on a few kind of big picture factors, some of which we've definitely talked about before. So I'll try to be pretty concise on this. But these are just things I think to keep in mind. Some of these things are factors that will be with us longer. Others perhaps will start to shift a bit as we get into next year. So yeah, specific to kind of the COVID effects, a lot of the readjustment has to do with e-commerce kind of getting back into the trend. People maybe made some mistakes, maybe a bunch of companies made some mistakes thinking this hyper growth was going to continue. It is important to mention that while the growth rates are going back to what we expect, e-commerce is still a much greater piece of the pie than it was pre-COVID. But like you said, there's the pull forward of big ticket demand. This period, which I think we talked about last week, might be starting to come to an end of kind of revenge spending, more travel, that kind of stuff. I think a big factor, which is likely to persist, is the casualization of wardrobes. That's one of the things, actually going back to the Neiman Marcus story, which I glossed over. But one of the problems for the high-end department store chains in general is that business environments become more casual. So the ability to sell suits, ties, very fancy dresses, et cetera, is greatly reduced. But we see this outside of luxury. If people aren't going into the office, whether it's a fancy white shoe law firm office or whether it's just kind of a regular, wardrobes have become more casual, which is why, this is a long-term trend. We started to see this way back when I was first in the apparel industry over 20 years ago. With business casual Fridays and these kinds of things, but the work from home has really taken this to a whole new level. So apparel in particular, I think, has got some very negative trends, which will ripple throughout the industry. The other couple things really quickly are, we still, if you looked at what's been said by the U.S. Fed and the European Central Bank, we're still looking at inflation probably coming down, but still relatively high. And one of the things I saw somebody comment on Twitter is, bear in mind, if inflation does get back to 2 or 3%, that doesn't mean food is cheaper.
No.
Right? It's growing less quickly. So even if you have 3% inflation, let's say, that still means groceries are probably, 20% higher than they were a couple years ago.
Well, there's some big exogenous forces driving food costs. The climate change is a big one. The war in Ukraine, another, and just a shortage of people. We've talked about that. It also affects agriculture. So food prices could remain high without some imagination. And there's lots of imagination in the industry. But for the foreseeable future, prices could come down in other places. But food prices could remain quite high for the next 12 to 18 months.
Yeah, and I think, we've also still in an environment, I think everything we've seen in the last couple weeks are that we're likely to see 1 or 2 more increases in interest rates, and that those interest rates are likely to remain high for an extended period of time. So certainly as we think about the balance of the year and going into next year, I think we're going to be in a, relatively speaking, high interest rate environment. And actually, as it relates to inflation, one of the kind of perverse things about high interest rates is that one of the reasons why housing costs are so high is that the supply is not where it needs to be. And when interest rates are high, that doesn't necessarily encourage, commercial real estate to be built. So there are some things that even if food prices come down, energy prices come down, other things come down, the housing situation is not likely to improve in aggregate anytime soon. So this environment where money is no longer free, we had a number of years where interest rates were so low that encouraged probably a fair amount of bad behavior that some of the government agencies are trying to correct. But so we'll see how that plays out. But to my point about real estate, housing, not likely to be very aggressive in terms of the supply increasing. At the same time, that puts pressure, as we've talked about in the past, on where retailers are going to spend their money in terms of distribution capacity in new stores. There's this whole other thing, which I don't even want to get into, but I think there is this, partially because I'm not an expert and partially because it scares the hell out of me, but I think there is this ticking time bomb in commercial real estate and office space. There's a lot of vacancies, a lot of refinancings that are going to come up over the next few years, a lot of lease renewals. So, that's just out there as I wouldn't say a black swan event, but it could get ugly. So I think as we look at the second half of the year, inflation is going to remain moderately high, particularly in Europe. at least one more interest rate increase. One of the things particular to the U.S. is, unless something happens that's unexpected at this point, is student loan repayments are going to resume in the U.S. That's 11 million people that are going to start spending, $50, $100, $200, $300,
Wow.
$400 a month to pay back their loans. That's not great for spending. And then,
particularly just discretionary spending, right? It comes right out of discretionary spending. It tends to impact that pretty deeply, right?
Right. So you have this potential squeeze of, we've seen savings come down with, credit payments go up, not wages, discretionary income not keeping pace with inflation. So I think the outlook is pretty shaky. The one real great thing, I guess, in this litany of bad news is the job market continues to remain strong. And even though some of the things we're talking about might slow things down a bit there, I think there's every reason to believe that the job market is going to remain comparatively strong, and that will definitely help the economy.
All right. So one of the things that our listeners tell us in person and in other ways that they like about our discussion here is that we just are not just chronicling the state of things, but let's talk about how to think about them, like what to do. Your retailers listening or people in the retail industry taking all this in context. What's your advice?
Well, one thing, this is just sort of my general advice, and it's something I've been digging into with my new book, is just really don't buy into the general narratives, the clickbait headlines. Really dig deep on what's really going on, and a few things there, like this idea that a slightly better version of mediocre is going to be a winning strategy. There's a lot of things that many retailers that are struggling are doing that are necessary but not sufficient. So just be really honest about what it's going to take for you to grow relative market share in what might be a down market.
What did you say? Necessary but not sufficient. I love that. I love that phrase.
Yeah, by that you have to do them. Like they're good ideas just to stay competitive. But in many cases, you're just kind of innovating to parity. It's not necessarily going to give you an edge. The second thing is just to be honest about what inflation, as well as kind of what the COVID stimulus bump did for your business. I just saw a statistic last week that 84% of retail sales growth in the U.S. last year could be attributed to inflation. So that's not real growth. And so just get rigorously honest about whether you are acquiring customers, growing customers, retaining customers at the rate you need to. I would say challenge yourself to look at those things that you maybe you've been doing for a while that really no longer serve you. And those could be processes, those could be people, those could be business formats. The other thing I think in general, and kind of my big picture comments on this, is really understand that all sales are not created equal. And that seems really obvious, but this tendency for a lot of retailers to kind of do these one-size-fits-all strategies, doesn't necessarily optimize. So as you think about cutting costs, or as you think about dialing up promotions, try to make them more targeted, because you can just chase the promiscuous shoppers and get your top line going, but in fact not really improve your profitability, not increase customer lifetime value, not drive up the net promoter scores that are going to really serve you over the long term. Another thing I'd suggest is what I call a degradation or friction audit. And by this, I mean,
what does that mean?
Well, so I can't remember if we've talked about this much on the podcast, but I think there's a pretty basic retail equation that leads to, your ultimate performance, which is, you got to get customers interested in your brand in the first place to consider you. Then, then the next part is you do that well enough that it drives traffic, whether that's to your website or to your store. How well are you converting the traffic that you get? How productive is the traffic that you get in terms of, average ticket, number of items bought? To what degree are you increasing frequency with the customers that you already have? To what degree are you retaining those customers? And to what degree are they remarking on your brand, whether you use Net Promoter Score or some other thing? Like, doing well across that kind of equation really ultimately determines a lot about your long-term success. So one of the things I suggest is take a look at how you're doing on all those different steps of that journey, and try to identify places, things that are getting in the way of performing well on each of those dimensions. So it could be, you're not getting considered because your SEO strategy is screwed up. It could be you're not converting traffic because you don't have enough sales help, or because you're not in stock, or what have you. It could be that you're not getting your net promoter scores because you're not doing anything that's really a wow experience, a memorable experience that would cause customers to be loyal to you, but
to remark upon
back,
you.
Remark upon you. Yeah. So I think, you're looking for barriers or pain points, friction, whatever you want to call it, that keep you from performing how you want to. But you're also looking for that wow factor that literally causes you to be remarkable. So it's in some cases, it's very basic conceptually, but very few retailers actually do this in any kind of disciplined way. And I think particularly in a down environment, there may be some, I hate to say low-hanging fruit, but in some cases, there really are some things that don't require a big technology investment or a ton of money to do that could, make your business perform better in the short term.
Last couple of questions. I want to do a rapid fire with you, because you've got, over the course, as I was reflecting on our season, there's a lot of things you say you shouldn't or don't do the following. And we're very positive. We try to be very positive in our messaging, but there's a bunch of don'ts that, I was ticking off some boxes. Go through quickly as a summary, don't do the following things. And then I want to end on where there's opportunities for leverage.
So one thing is what I call, it's really a reminder, which is that bailing doesn't fix the hole, if you know that expression. Right. And this is more of a strategic issue than, a next 6 months issue, perhaps. But a lot of the retailers that are struggling have a relevance problem, not a cost or too many store problem. So don't fix a relevance problem, or don't think you're going to be able to fix a relevance problem through cost cutting or store closings. I would say the other kind of, and this is a backdrop to a few other things, is most downturns, and we'll see. I mean, we've been in an unusual period, obviously, the last few years, and it's much harder to predict what the next year or two is going to look like. But to the extent we have a downturn, and I think we're much more likely to have something closer to a softer landing than a true long-term recession. But most significant downturns last less than a year. So you don't want to overcorrect. You don't want to get so focused on this big program of cost reduction and layoffs and deferring important technology investments, so forth, and then just discover, 9 or 10 months from now, you're starting to fall behind, or you can't resurrect those efforts easily. The second thing I'd say or another don't is, don't confuse efficiency with effectiveness. And part of the reason why I like this, year of living efficiently, is a lot of that stuff is important. But again, you need to make sure you're spending time on things that are really going to allow you to win, grow, and keep customers and get that remarkability factor. I would also be careful, when we get into tough times, there's a big tendency to cut long-term stuff, kind of the focus on the urgent and lose sight of the long-term important. And a lot of retailers, the reason they're not successful is they're not transforming or innovating enough. And you don't want to destroy your innovation pipeline, take so many short-term actions that, again, you'll wake up a year from now and go, oh, we got nothing in the pipeline that's really going to be important to long-term.
And we're another year away from having something in the pipeline. So
exactly.
You're 2 years from today having something interesting to turn your relevancy issue around. Right.
So I think you want to kind of get this balance between, yes, you've got to be, appropriately frugal at times. You've got to perhaps reduce risk in an uncertain environment, but you also want to position yourself to be able to step on the gas as conditions improve. I guess the last don't I would say is, and I kind of touched on this earlier, is try to avoid the one-size-fits-all approaches. If you, you don't have to smooth the peanut butter over everything. You can perhaps go deeper and say, these are technology investments that are really important. We need to keep going on them. Or take a handful of stores and be piloting things so you contain your investment and your focus, but you're learning. So again, you're ready to move ahead and scale as conditions improve.
Longtime listeners would know we have and have had a wobbly unicorn segment where we frequently talk about these alleged disruptors who are not doing so well. But you make the point that now is the time for retailers to perhaps press an advantage when these folks are not disrupting and maybe but have raised some interesting ideas to go after that customer, that market. Is that what you're thinking today and for the rest of the year?
Well, it's tricky. I think this is a place, and there's actually a Bain study recently which fit with my intuitive sense, but actually provided some data, is that strong companies tend to do better in a downturn, and weaker companies tend to get even worse. So you've got this divergence in outcomes. And so I think if you've got a strong balance sheet, if you've got good operating momentum generally, and
good people,
a real point of differentiation, there's a real opportunity to step on the gas and, kind of take advantage of the so-called wounded gazelles, right? Because there are going to be, I think, Overstock, the thing we talked about earlier, Overstock being able to buy up Bed Bath & Beyond assets at a ridiculously low price. And so there are going to be opportunities like that. So if you're a strong player, you've got a good balance sheet, you can take a longer term perspective. So that could be, going after store openings, testing and learning more stuff, going after customers that are getting neglected perhaps by the weaker players that are pulling back on marketing or pulling back on staffing or what have you. So I do think we are likely to see the strong get stronger. I think those retailers that are, have been stuck in the unremarkable middle, they're going to continue to tread water because they worse, contract or even, go bankrupt because they don't have a compelling strategy, and they're likely to get caught up in needing to pull back, which will likely make matters worse and could actually start a downward spiral. And then I think, some of these disruptor brands that we've talked about a bunch, the issue with them is, many of them are already losing a bunch of money. The economic outlook for the next 6 to 12 months is not probably going to help them. Some of them have relatively weak balance sheets. So I think we are going to see some hopefully not bankruptcies, but, maybe either some backing off on some of their strategies, or maybe they get acquired by a stronger player.
Well, and of course, we're already starting to see that, right? Casper in Canada acquired by a great retailer, strong retailer. I mean, it's the epitome of what you've just been describing for the past 5 minutes, right? Great retailer, well-run, the Gazelle trips, and now Casper's run by Sleep Country. So, word, my friend, word.
I think what I would say, just to, which is maybe a bit of piling on, but I think what I would say is, and I don't know, you can find an exception, but I would say just about every trend that's been important in the past 6 months is very likely to get amplified in the next 6 to 12 months. So, maybe the only exception is we might start to see some of the big ticket sales, maybe that starts to turn around a little bit just because the passage of time.
Sure.
But kind of fundamentally, I think the things that were good ideas in the fall are still good ideas.
They're going to be great ideas. They're going to be great ideas. Yeah.
But if you're struggling, most of your problems are likely to unfortunately become more pronounced. So don't sleep on doing what you need to do.
Well, a great way to end our season. And of course, for perspective, we'll be back on the mic in the fall. So we're not just going to be predicting what happens. We're going to be codifying it, analyzing it, and talking about it in season 7, which once again launches in July. And until then, we're going to take a little bit of break, but we're also going to have some encore episodes, some of our great interviews. But for now, let's put a wrap on this episode, this season. Appreciate you, my friend. It's been a great season. Looking forward to
yet
again another season. And we'll be seeing each other in person, which is wonderful, in New York City in July. So until then, be safe and travel well and keep cool in that hot temperature Dallas place of yours.
I'll do my best and stay hydrated too. Always good advice. That's actually my big takeaway.
Your big
from
takeaway
the season is floss, stay hydrated, don't be a jerk.
All right, perfect. Let's leave it there. If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Judith McKenna, President, International, Walmart. And be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can see both of us at the Lead Innovation Summit in July, live on stage in New York with our friend of the pod, Simeon Siegel from BMO. Until then, safe travels, everyone.